Hello, this is Randy Alsman from Donaldson Capital Management. I'm bringing you the takeaways from today's Investment Policy Committee meeting via this audio blog. Today's discussion was broad-ranging, but focused primarily on the U.S. economy, how it is playing into the behavior of the stock market recently. That behavior is, as you would expect, tied to Europe and lately Spain. We'll discuss a little bit about those dynamics and how they are affecting the market. Then we'll get back to a little brief discussion about the Fed's influence over the performance, overall outlook for the market for the rest of the year and the economy for the rest of the year, and how that plays into our strategy for our portfolios over that same time frame. As you take a look at your screen now, you'll start seeing some charts that are various indicators of economic performance. These are all for the U.S. economy, and I won't take time to explain each of them in detail. I apologize for that. But what you'll take away from these, I hope, is what we took away from them, which is that you see an economy that is not providing a compelling story one way or another. It does seem to be slowly improving, as we've said for quite a while now, is slowly strengthening in its various indicators, but it is not taking off. It's not providing us rapid economic growth, nor is it collapsing like it did in 2009. It's a pretty boring story and not a very impressive one. Net positive, but still not very compelling. The one chart on here was the first one you saw, which was after-tax profits. We'll flash that back up again here in a minute. And what you'll notice on it is a big spike up of the red line, which are the after-tax profits of U.S. companies. And that is a pretty impressive number. It's not enough on its own to pull the whole economy along with it, but it does tell you that despite the slow movement of the economy, our companies out there are finding ways to really ratchet up their performance, which is a good thing. But if you go to the overall takeaway I mentioned, which is not a compelling story, what that means is the people who are long-term, large-scale investors in the market that make their investments based on a fundamental long-term trend that they're betting on don't see anything compelling in the way of an inflection point in that trend, nothing up or down that's dramatic. Since there's no real change in that outlook and it's not an impressive performance, they're sitting on the sidelines. They're not really doing a lot of active trading. What that does is leave the market in the hands of people who love to trade actively. In fact, they may trade actively hundreds of times, or in the case of the nano traders, they may trade thousands of times a day. They don't care about the underlying fundamental story. All they care about is movement, and movement in either direction is just fine with them as long as something moves. And they will make their judgments based upon trend lines on a chart, squiggles and averages, and not at all upon the fundamental strength of either economies or companies underneath. And anything they can do to accelerate or exaggerate those trends one direction or another in a direction that they would bet on is to their advantage. So what we're seeing is, as we mentioned last week, trades, not trends, in the volatility of the market. And what you're looking at now is a chart of the S&P 500, which takes a look at the last 12 months of the market's pricing. That is the black line, the price index for the S&P 500. The colored lines are moving averages, multi-day moving averages. The most important one is the green one, which is the 200-day moving average. That's a significant point, and you can see it several times in the history where once it pierces that number one way or another, the market tends to keep moving pretty aggressively. There are times when it bangs up against it or down against it and can't get through it, and those are times when you don't have a compelling fundamental story that move it one way or another. You notice last August it pierced that going down. That was the big European crisis of last summer when things really notched up in intensity and nothing much changed through the end of the year. And then we started getting positive comments about U.S. GDP in the fourth quarter, and corporate earnings surprised very positively. And so that was a fundamental story that could pierce the 200-day moving average moving up right about January 1st. And that continued until Europe hit us once again and the U.S. GDP numbers were revised to show less robust growth, therefore moving the market down. And once again it fell through the 200-day moving average, but just briefly, and came back up. What we're seeing here, at least what we believe we see, is a market that doesn't have an underlying theme. It doesn't have an underlying economic theme other than reaction to short-term movements and reaction to the people who are trading stocks rather than investing stocks, shorting and going long, doing everything they can to create volatility because that movement advances their income, whereas for the longer-term fundamental investor there's not much there to go on and they continue to sit on the side. One of the things that these short-term folks really love are dramatic headlines, and it seems that Europe loves to create them. You've all heard in the last month or two about the latest ramp-up of concern over Europe, and Spain was the country in the dock for that over the last several weeks, first denying and then slowly backtracking on their denial that their banks are in such trouble that they need outside help. Spain is a little bit of a different story here from Greece and Portugal and Ireland. Spain's problem is not runaway deficit and debt, although they certainly have their debt and deficit problems. Their issue is the private sector, the banks, the cajas as they're called, regional banks that were very aggressively betting on rapid real estate expansion back when everyone else in the world was, but they were betting on steroids. They were very aggressive and made lots of very bad loans. And as a result, a lot of these Spanish banks are now sitting with balance sheets that are weakened by a lot of non-performing loans, a very high percentage of non-performing loans. These banks are so large in comparison to the federal budget in Spain, which is the case for most banks in most European countries, that the federal government did not have the financial wherewithal to bail them out. Therefore, they appealed to the European Union. The European Central Bank over the weekend said that they would step in and provide 100 billion euros, or about $125 billion, to help the Spanish government help their banks stay afloat. That, of course, puts another 100 billion euros of debt on the Spanish government, which is not necessarily a good thing, but it forestalled an immediate collapse of their banking system, which could have spread in a contagious way across Europe. So that is the latest in the European news. Certainly lots of drama involved there. It is not a solution, this 100 billion euro loan. What we've seen in Europe is that the continent is slowly, painfully dragging its feet toward a real solution which inevitably requires each country in the Eurozone to give up some level of financial sovereignty in order to get a consistent discipline and enforcement of that financial discipline across all countries in the Eurozone. That's not something any individual country likes to do, to give up their sovereignty in any area, but it is one that they are slowly being dragged toward, and the solution is becoming more clear to all of them that they can't avoid it. It will continue to drag on. So what does that do for us here and investing in the market? We're going to see a lot of sideways movement. We're going to see just what we've seen over the last year or so, that the market's not going to make any permanent move until there's a compelling, enduring economic story. As a result, it's going to be moving up and down in a jagged fashion as the speculators use those movements to their advantage, but they can't make any long-term fundamental push that lasts. The lasting moves for stock markets, those that last over years, are driven only by underlying fundamental strength. You cannot change the tide by pushing ripples outward from the shore. You can only go with the tide. It is a stronger force than any short-term waves you might create. That's what we're seeing in the market, and that's what we expect to continue to see. One of the other headline grabbers is the U.S. Federal Reserve Bank, and if you go back to the chart of the S&P 500, you can see the market turned up before the bailout of Spain, here most recently. That was because toward the end of last week, several important Fed officials, including Janet Yellen, vice chairman, were hinting in speeches they were making around the country that the Fed stood ready to provide additional stimulus to the economy. The Fed has a dual mandate. They have to help support full employment as well as price stabilization. They are not allowed to sit back and say, well, we're not going to stimulate the economy to support employment because we really think it's in the better long-term interest of the country to let that slide for a while. They can play around the edges of that a little bit, but eventually they will have to take some action in order to support their mandate from Congress. As these Fed officials hinted that, of course, the traders love stimulus, and so they boosted the market up. Last week, it's back down again slightly, about 0.5% today, and that's as everyone realizes the Spanish Band-Aid was just that. It's not a permanent fix to the Eurozone problem. U.S. stimulus is not a guaranteed thing, that the Fed officials were hinting at it, but no one made a commitment. So we're left in a pattern that I think we're going to see, that the committee believes we're going to see for the next several months, which is a lot of volatility without any underlying trend one way or another. We also, though, if you'll go back to that chart on corporate profits, we believe this is a significant point. Corporate profits are still very strong. They're at record high earnings, and valuations for companies are very low. Not the lowest they've been, but certainly very low historically. So we still think that in the midst of all this chaos, in the midst of all the headline grabbing, and the midst of a fundamentally slow economy, there are many companies that are doing quite well. And we believe those are the kinds of companies that will continue to do well throughout this period and hold their value. They may not race to the moon on super high price rises, but we do believe that they will hold value and will continue to find ways to support their balance sheets, which are incredibly strong throughout this turbulence. Therefore, we are maintaining our portfolio in a more of a defensive posture as it has been until there is a stronger indication of a permanent trend one way or another. We don't believe it's appropriate to shift, certainly not to make it more aggressive, so we will stay with a relatively defensive portfolio posture until we see a change in the market that we believe is lasting. I hope that was helpful and informative, and we'll talk to you all next week.